Welcome, everyone, to today's explainer of the Global Strategy Daily Report for August 28th, 2026. I'm your host, and today we're diving deep into a massive macro theme that's basically defining the current market. We're looking at a brutal collision between central bank impatience and multidimensional market polarization. We are going to strip away the noise and look strictly at the data. We're hunting for the structural shifts in global asset pricing models so you know exactly how institutions are rebalancing their portfolios today.
Here is our roadmap for today. We'll start with macro sentiment, move through treasury and currency dynamics, equity market microstructure, sector rotation, institutional risks, and finally wrap up with our final strategic verdict. Let's get right to it.
Section 1, Macro Sentiment and Foundation. We absolutely have to start with Fed Chair Kevin Warsh's speech at Jackson Hole because it was a total game changer. He said, and I quote, "We must be confident that underlying inflation is moving to our objective clearly and of sufficient speed. Otherwise, we have work to do." Now, the institutional market is already calling this the Warsh Doctrine. Basically, the era of friendly forward guidance, that's completely over. The Fed is laser-focused on absolute price stability, and they are willing to shock the market to get it. It actually feels a lot like the early days of Paul Volcker in the 1970s. Quant models are scrambling to price in this new uncertainty premium right now. So why is the Warsh Doctrine so aggressive? Well, look at the sticky inflation components. Headline CPI is sitting at 3.0%, which seems okay on the surface, right? But pop the HUD. If you look at the Fred Series ID CUSR0000SAH1 for shelter, structural housing shortages are keeping it stubbornly high despite base effects. And then you have services, that's CUSR000SASLE, which is running way above target because of a super tight labor market. Even used cars, CUSR0000STEA02, aren't giving us the downside relief we need. This data tells us exactly why getting that last mile of inflation down is going to be incredibly painful. And the market is finally waking up to this reality. The CME FedWatch probability for a September rate hike just jumped to 50%. Literally half the market now thinks we are getting tighter, not looser. This sudden repricing of rate expectations feels very much like the year 2000 dot-com bust, where the Fed unexpectedly squeezed an overheated market. The market is basically surrendering to the fact that the Fed will not tolerate sticky inflation, even if it means risking jobs. All right, moving on to Section 2, Treasury and Currency Dynamics. You can see the transmission of this hawkish shock straight in the yield curve. The short end is reacting incredibly aggressively. The 2-year yield spiked 7 to 8 basis points, hitting that 4.31 to 4.35% range. But the 10-year yield, it's completely flat around 4.73%. So what does this actually mean? It means the yield curve inversion is deepening. This structurally crushes banks' net interest margins, which makes banks incredibly defensive with their lending. And when credit creation slows down, institutional models have to bump up their recession probabilities immediately.
This rate dynamic is bleeding directly into the currency markets too. The US dollar index, or DTWX-BGS, is showing massive strength, holding above the 99.6 level. We call this the straw effect. Higher short-term US rates are acting like a giant straw, sucking global liquidity out of emerging markets and pulling it back into the US. This is a total nightmare for EM assets. It threatens huge sell-offs and drains foreign reserves, which really just fuels more global macroeconomic imbalance.
Let's dive into Section 3, Equity Market Microstructure. So how are stocks digesting this new macro reality? Through extreme, multidimensional polarization, megacap tech is holding up the indices with their massive cash piles and AI momentum. But if you look under the surface at the Russell 2000, ticker RUT, it tells the real story. It closed today at 2,974.32, dropping exactly 1.33%. This proves that true market breadth is actually terrible. Smaller companies that rely on debt are buckling under these higher rates. This massive concentration in just a few megacaps is a classic early-stage risk-off signal. But here is the crazy part. Despite the rate shock and the small-cap sell-off, the VIX, ticker VXCLS, actually closed at a super calm 1451 today. How is that possible? Well, it's not because institutions are relaxed. It's because of very mechanical options positioning. Smart money is quietly adjusting their quant models rather than panic-buying put options. But honestly, a VIX at 1451 in this environment is like a ticking time bomb. One tiny shock could trigger a massive gamma squeeze as market makers are forced to violently hedge their positions. To double-check if this calm is real or just an illusion, we look at the credit markets. The high yield spread, Fred series BAMLHOA0HYM2, is sitting at 2.63%, actually tightening by 0.04% today. That means junk bond markets are completely ignoring the equity polarization and the rate hikes. Large institutions still believe there's enough liquidity and corporate cash out there to keep taking on risk. So the overall index levels are actually still being supported by fundamental credit confidence, not just temporary positioning.
Okay, Section 4, Sector Rotation and Alpha. We have to look at the exact performance across all 11 GICS sectors today to see where the smart money is moving. Tech, XLK, took a hit, down 1.53%. Rate-sensitive utilities, XLU, dropped 1.09%, and real estate, XLRE, fell 0.45%. Industrials, XLI, were down 0.95%. Materials, XLB, down 0.12%, and healthcare, XLV, was down 0.23%. So where did the money go? Financials, XLF, went up 0.37% as they benefit from wider rate margins. Energy, XLE, gained 0.58% on inflation hedge demand. Consumer staples, XLP, added 0.41%. Now, interestingly, discretionary, XLY, jumped 1.15%, and communication services, XLC, soared 1.40%. But don't be fooled by that. That is just a few mega-cap platforms buying back their own stock, which is masking the broader sector weakness.
Now, let's talk strictly about digital assets for a moment. Bitcoin BTC USD closed at $77,524.26. which is a sharp drop of 3.41% from yesterday. We don't just view this as a niche asset. We view this as the most pristine, hypersensitive antenna for global liquidity. This exact drop is a pure, distinct risk-off signal, showing that crypto capital is already fully pricing in the reality of the Warsh Doctrine's liquidity drain.
Commodities are flashing the exact same risk-off warning. WTI crude, ticker DCOIL WTICO, fell $2.44 to close at $83.90 a barrel. Traders are heavily betting that higher rates will eventually crush manufacturing demand. And gold, ticker GC=F, dropped 2.23% to $4,506.90. When gold, the ultimate inflation hedge, drops like that, it means spiking real yields and a surging dollar are overpowering even the instinct to seek safety. It is a massive disinflationary signal.
Section 5. Institutional Insight and Risks. Let's filter out the media noise.
What geopolitical events are the smart money models actually pricing in right now? First, that massive $500 billion AI data center project in Piketon, Ohio, is facing severe local backlash over power and water. That is exposing the physical limits of AI infrastructure growth. Second, those devastating floods in Nepal are creating localized supply chain shocks that could easily reignite inflation and squeeze corporate margins. And of course, the approaching U.S. elections are injecting massive policy uncertainty. Quant funds are looking at these delayed risks and structurally increasing their cash positions as a defense mechanism.
Finally, Section 6, the final strategic verdict. Based strictly on today's data cascade, we have two binary paths forward. Scenario A is the bullish case. AI capital expenditures manage to completely overpower the high cost of capital. If tomorrow's data supports this, you overweight mega-cap tech and financials. Scenario B is the bearish case. The Warsh Doctrine forces a structural decay in corporate earnings. If we see the Russell 2000 break down further and the VIX starts to wake up and spike, you move to maximum cash, heavily underweight small caps, and implement short hedges immediately. You have to follow the data mechanically here to protect your capital.
So what is the black swan tail risk the market is completely ignoring right now? While everyone is staring at the Fed and big tech earnings, the real danger is a shadow banking liquidity vacuum. High yield spreads look calm today, sure, but if a crack forms in private credit or commercial real estate because of these high rates, it could trigger a catastrophic chain reaction of leverage unwinding overnight. Do not let today's calm fool you. When the tide of liquidity rolls out, any asset without fundamental backing is going to be ruthlessly liquidated. Thanks for tuning into today's explainer, and stay sharp out there.